Okay, good morning and welcome to the Shenkman Private Client Group Account Attorney Fall Webinar Series. This program is entitled Tax Credits and Incentives to Benefit Growing Businesses. For those who don't know me, my name is Jonathan Shenkman. I'm a financial advisor, portfolio manager, and an accredited investment fiduciary at Oppenheimer based in New York City. The goal of all my programs is to bring professionals together to help them better serve their clients. This is done by educating attendees on the latest topics in wealth planning and by encouraging collaboration between a client's attorney, CPA, and financial advisor where appropriate. My practice focuses on working with high net worth families, businesses, and not-for-profits. I manage individual investment portfolios, trust accounts, corporate retirement plans, and endowments to help my clients achieve their financial goals. In addition to the 20 to 25 events I run every year, I also do a fair amount of writing on the topics of investing and financial planning. You can read my work in Barron's, CNBC, Forbes, Kiplinger, the Wall Street Journal, the CPA Journal, Trust and Estates Magazine, and many other periodicals. After the program, I'll send out a link to all the publications where I publish my work. Today, we're privileged to hear from Barry Halpern and Mark Leaheey, both CPAs at accounting firm Marcum, LLP. Barry is the tax and business service partner based in New York, where he helps clients navigate the complexities of all areas of state taxation, including general consulting, audit defense, strategic planning, nexus consideration and resolution, sales and use taxes, due diligence for mergers and acquisitions, audits of state income tax provisions, and state tax compliance. Mark is a tax director based in Chicago, where his practice focuses on discovering credits and incentives available to businesses, including relocation, expansion, employment, and capital expenditures. Today, Barry and Mark will speak on tax credits and incentives to benefit growing businesses. And with that introduction, I'll now turn the program over to Barry and Mark.
Thanks, Jonathan. I really appreciate it. Hi, good morning, everyone, and thanks for joining the program. Today, I'm privileged to be presenting with Mark Leaheey, a director in our Credits and Incentives Group. I'm Barry Halpern. I'm a tax partner in Marcum's Tax and Business Services. I focus on state and local tax opportunities and consulting, primarily nationally in Marcum. I bring strategic tax benefits, including credits and incentives from a state tax perspective. Mark is in our National Credits and Incentives Group, focusing on the research and development credits. And today, we're very excited to present state tax credits and general tax credits, R&D, and incentives to benefit growing businesses. So before we get into the program, we wanted to throw this out on the screen. Take a look. Do any of the following apply to your business? Or if you're a service provider, to your clients? Are your clients or your business looking to expand business or purchase a new location? And by expansion, it doesn't necessarily mean they're making this huge expansion project. Think about hiring new people, creating a new product line, something like that. Many times we speak to a client like I do, and they ask me questions about, does this property qualify for this? Is there this depreciation, this expense? I'm making this new product, how are we going to be taxed in the different states? And while we're all consultants and we want to answer that, or your businesses are thinking about the tax impact, many times you don't think about, wait a second, this is new, there's going to be new people here. Should we be thinking about credits and incentives? Are they making significant capital additions? They need to buy some new machinery. They're a manufacturer. They're developing some technology. They're buying a bunch of computers, anything. Are they going to be making a significant capital addition? They're building a building. Are they attempting to develop a new product or process? Increase planned wages? Are they hiring people, retaining people? Are they going to go into a new targeted area or targeted industry or a zone? All these questions, anytime you see companies expanding, you get their apportionment work papers from year to year. You see a change. You talk to your clients. If you're a CFO, if you're a business, you're looking to hire, hiring credits. Does that come into your mind? And if not, you should be asking the question and speaking to your advisors. Next slide, Mark. So today's objective, it's a half-hour call. It's very difficult to cover all the credits and incentives. But what we wanted to do is give you a little bit of an overview of why credits and incentives, what they're there for, how you go about taking them, a couple of specific programs, and then introduce the R&D credit. Because as you'll see, there is a very big interaction between state and local tax credits and incentives, or just credits and incentives in general, and what you need for the R&D credit. And many times there's an overlap. And so Mark and I work together on many projects and clients, because when you're doing R&D and he's focused on the federal R&D, besides for just being a state that just gives you a state credit based on R&D, many times there's other programs that do ping to the R&D. They pin to the R&D. And so what we decided to do is talk about just some general programs. We focused on New York, and I know there may be people that are not in New York, or not businesses not in New York on this program, but considering the location of this program and where we're based out of, we focused on New York. There's some good programs there. That said, many other states do have similar types of programs to incentivize business growth and operations. Next slide. Let's dig right into it. Why credits and incentives? Why would a state or a federal government want to offer credits and incentives? So states, they would like to promote business. They're trying to use this. This is a government tool to incentivize or promote certain activities by businesses. They have certain distressed areas. Many times they need economic development. There's certain zones we've all heard of, or certain parts of their economy they want to stimulate. And so what they do is they offer these incentives for businesses that are either in or are looking to get in or may leave, to either invest in that area and build it up, or maintain certain jobs or activities primarily that are going to lead to high-paying jobs in that area. And so what that does is that influences companies that are looking to do a project to create that project in that state. And many times other states or other even local jurisdictions within the states have competition between them, meaning they'll offer different incentives depending on where you go, or whether you're going to leave that location and go somewhere else. And so that promotes the growth in those areas. It also is actually a return to the state, because the more companies invest and grow and build in that state, the more tax dollars they'll receive out of it. And many times in certain programs, as you apply or make and do the annual ongoing compliance for those programs, there's actually a return factor where the state looks to see, well, what return on our investment are we getting? So as you see, states do want to promote things, but they're also getting something back. So that's why you'll get a lot of credits and incentives from states or other jurisdictions. So incentives generally target specific either industries or types of investment, right? They want new big capital investment, big projects coming into their states, a lot of jobs, higher paying jobs. And that's why we see certain technology companies, software development, manufacturing, there's either going to be a big spend on tangible property or some buildings. There's going to be higher paying jobs in the high tech industries, which means you'll have to train your employees. You'll have to have higher paying jobs, which leads to tax dollars. There's also environmental objectives, green projects, energy conservations. Those are big on some state agendas, and therefore they'll offer credits and incentives by reducing carbon footprints, as many of that as well. Now, most companies end up not taking advantage of all these credits and incentives. There are so many credits and incentives across the states and all jurisdictions, tons. Now, why doesn't everybody take advantage of this? Well, either they're just not focusing on it, they're not aware of them, they don't spend the time to speak to someone to look into it. It's complex. Many times there's a negotiation process. You got to maintain certain objectives, and the compliance and approval process is difficult, but it could be very beneficial. And therefore it's important to just keep in mind that anytime you see what we spoke about originally on the first slide, these type of investments or hiring type of businesses, credits and incentives is something that could really benefit the business. So let's talk a little bit about the types of credits and incentives that generally we see. We can either have a flavor of what we call a statutory credit as of right. That's a credit that's in the statute. That's right there. You hired a certain amount of employees in a certain area, that you're a software developer in New York, and you created a certain amount of jobs and you qualify by statute. That's basically yours. For the most part, you don't need applications. In certain instances, you do need some sort of applications, but essentially if you hit that statutory credit, that's yours. You could take it on a tax return, and generally that's where they're claimed. Those types of credits are subject to audit. An auditor can come in and say, hey, let me look at your payroll. Let me look at what you've invested it in the state. I want to make sure that that qualifies in accordance to the guidance that was put out there by the statute and the regulations. So that's an as of right credit. But then there's also discretionary, or as we call negotiated credits. And those is really where you're going to enter into discussions. And most of the time, you'll have an application process. There'll be discussions. You want to say to the economic development unit that, hey, we're either going to leave or we're trying to go into this, and you'll be discussing it beforehand. You need to have those conversations prior to any investment or any cash spend in order to obtain those credits. And it could come in the form of cash grants, income tax credits, sales tax exemptions. We've seen property tax abatements, et cetera, utility tax rate reductions, or property tax. We said that. So those are the things that states are looking to incentivize, either big projects or retention of projects, and they have these units set up. Sometimes they're funded by a certain amount that they can provide, but you negotiate based on what you're looking to do and based on what the state is looking to attract. You can negotiate certain incentives, and again, those are the type of incentives that need to be negotiated on the front end. Again, types of credits and incentives, we see capital investments, job creation, industry-based credits. We mentioned, technology, manufacturing are big. We also see film credits, production credits, location-based. You're in a certain zone. R&D, Mark is going to cover that, but certainly state to incentivize research and development as well. They come in the forms of just an income tax credit. They can be cash grants, financing, property tax, payroll tax credits. And those other incentives are sometimes specifically good where you have a non-refundable credit where you're not going to get the benefit. So some states really caught onto this, like companies aren't benefiting from non-refundable credits as much. So, they have these other programs that actually, is cash, and companies get that because it can help with a project. It can give cash in the door. Or there's what we call transferable credits. You can sell your credits for cash. In New Jersey, some credits, Pennsylvania, could be sold back to the department for a certain percentage. Investment credits, an example that we threw in New York investment tax credit for either manufacturers or R&D property or waste facilities. Those are examples of ITC credits, and it promotes certain capital investment. Continuing on that, that's the New York State ITC is an investment tax credit. We're going to go through a couple of New York specific. Other states have investment tax credits. New York is not the only one. But this generally, it's to promote the investment of tangible personal property or even building of structural components in the state. There are some parameters. It's got to be in the state. It's got to be owned. You can't lease it. Generally, it has to be depreciable over a certain amount of years. And once it has to be primarily used in your business to promote a certain activity. For example, manufacturing. It's a manufacturing asset. It has to be principally used in manufacturing of product for sale. That would qualify for New York ITC. And those credits, if you're a new business, could be refundable. If you're not a new business within the 5 years, it has a certain carry forward period. The percentages range between whether you're a corporation or it's a flow-through entity, but essentially that's what it is. Then, if you are investing and claiming the ITC, New York State also has an EIC, which is an employment-based credit that gives you an additional percentage of your ITC base above and beyond your ITC base if you are hiring employees over your base period, which is the year prior to ITC. If you're having 101%, you have a net employment increase, and you're claiming the ITC, you could potentially get this EIC. It doesn't apply if you're a corporation that elected a special R&D rate for the ITC. So the ITC, there is an R&D optimal rate. It's a higher rate for an R&D type property invested in New York. If you claim that, it's a much higher rate. They won't give you that. But otherwise, you can get this added on bonus. New York State qualified emerging technology company credits, also very lucrative. There's an employment credit there that's refundable. It's $1,000 over 3 years for increased employment. That's essentially a company that, and don't let emerging fool anyone. You don't have to be emerging necessarily or be a new business, but essentially if your primary products or services in a type of technology, think about it from information technology, or computer integrated, or medical technologies, types, aero defense, any technology types companies, there's a list of them, and your primary products or service is based on that type of business, and your product sale is under 10 million, then that's product sale. Then, or if you have R&D in New York and you have a certain percentage of R&D, there's two ways to get there, then you're entitled to call yourself a QATC, and you can obtain very beneficial credits. And it's for employment credits, and also for investors in QATC, there's beneficial credits as well. Hold on, I have some technical difficulties. Apologize that. And then the last bullet point here, and I'm going a little fast here because I need to make room for Mark to chime in. The New York Excelsior program, Mark, if you want to go to the next slide. There's so many. The New York Excelsior program is a discretionary program, and you can see here a list of other programs that are there. We're not going to be able to go through all of them, but there's a bunch of tracks there. They've just added on this year in April. The governor signed another track. There's essentially 5 tracks. This discretionary program where it's to promote investment and expansion in New York. Essentially, if you're in a certain type of industry, that could be software development, manufacturing, financial services, back office. There's different specific industries that they're looking for, and they're also trying to look at where you're going to be expanding, hiring people, investing. There's a jobs track, there's an investment track, there's an R&D track, there's a child care service track that was this year that was added on, and there's some big project tracks. It could be a pretty big benefit for companies. It's a refundable credit, and it's over 10 years that you get to take it. It's a kind of a pay-as-you-go credit. You need to apply beforehand, have those discussions, but once you get it and you set certain targets that you will hit. I'm going to hire X amount of people. With the terms are negotiated up front, obviously, and basically you get a credit every year that you hit those targets. The state then releases credits to you that you can claim refundable on your return. Some of these others are hiring credits, like youth jobs programs. I've seen that in the healthcare industry. People are familiar with WOTC. WOTC is something similar New York has, and then other incentive programs. You could take a look at training. New Jersey has an emerge also similar to Excelsior to promote investment in certain areas and jobs growth in the state. And California competes, which is a very competitive program, but could be very lucrative, where companies compete based on what they're going to be doing or potentially leaving the state, and then saying what the return would be. And actually, that's an interesting program because you kind of name the amount that you need to have in order to make this project work. And that's how California analyzes it. It's a very competitive program, but those are some of the big ones that we've seen here. And I threw out the West Coast because, give some love to the West Coast. Use of the state credits and incentives. So who can claim them? The entity that makes the investment or the operation, whether it be a C corporation on its return, sometimes it's limited to a fixed dollar minimum tax. S corporations, LLCs, partnerships, they can flow through. These credits could flow through to the owner at many times. And as we discussed, it could be just claimed or negotiated. And then but what's important on this slide for discretionary, many times it is disclosed. So be aware that if your company does take advantage, or if your client is looking to take advantage of certain credits, states have the right to disclose them, and they're public information. Thank you. Let's keep going. They're administered let's keep going, so thank you very much. Mark, I'll turn it over to you.
Great, thanks, Barry. So we're going to talk about R&D, or research and development credits. And R&D credits are really the opposite side of the same coin when it comes to statutory or negotiated incentives. If you are applying or able to receive many of those credits, you should also look at R&D. And really why? Well, it comes down to improved cash flow. The R&D tax credit in some circumstances is refundable, but for many, it's saving money on your taxes. It reduces your tax liability, and then you can save that saved cash you can use in your business in other ways. Various types of industries are highly important for R&D, manufacturing, software, food and beverage. But we like to say, start with the art of the possible. There are garbage companies that get R&D credits. There are clothing companies that get R&D credits. The biggest thing you want to avoid is telling your tax professional, well, we don't do any R&D. As we'll find out later, the definition used by the IRS is very different than the vernacular. There are some misconceptions out there. So what are some of the big misconceptions? I just listed a few. Some people say it's only for companies that invent something revolutionary. That's not true. The IRS allows small incremental changes to your business or to a product. The next one is one we hear often. Well, we failed in our research. We didn't make anything, unfortunately. Well, there is no success criteria. There is no success test. When we're talking to companies about R&D, we actually like to hear about the failures more often than the successes. Another big one is, well, it's only for big companies. That's not true. I've gotten R&D credits for companies with 2 employees, and I work on credits for thousands of employees. So it's really based on the activity, not the size of your company. So how does the IRS define R&D? Well, it has a 4-part test. And as you can see, nowhere is there a discussion about success. If we look at number 3, the elimination of uncertainty, this is an important one. Uncertainty is in capability, method, design. Just because you can get to a right answer doesn't mean you know the most appropriate way to get there. I always like to sum this up as putting theory into practice. Just because in theory you should be able to find an answer doesn't mean in actual practice you can. Translating something from a computer, a drawing, into the physical world can be very challenging. So what are some of the major components that go into an R&D credit? The major component is wages. Wages is the driver of 99% of all credits. Really think of the R&D credit as a hiring credit. It's a jobs credit. So, and the interesting thing is you don't need to have engineers in your staff. It could be maintenance individuals. It could be CEOs who are coming up with ideas and strategizing. The IRS allows for something called support and supervisorial time. What that means is if you're not turning a wrench or a bolt, but you're reviewing a group of projects, you can potentially qualify. Supplies, those are tangible supplies used in the R&D process. It's important to note this does not include machineries purchased, but in many cases, if you are purchasing a new machine, automating a line, many times you're using various consumable supplies to test the outcomes of that new machinery, and that's an R&D expense. And then the other factor is contract research. Those are generally third parties. They have to be here in the U.S. that are assisting you. And then the IRS automatically takes a 35% haircut. So what are some examples of some activities? This is not a full laundry list. There's just some major examples that we see. Advancement of existing products or processes, correction of defects, launching activities that can involve maybe a new component or a new process, designing and testing of tooling. If you or your clients are in manufacturing, you should be looking at the R&D tax credit. I'm going to turn it over back to Barry, and he's going to wrap it up. Barry?
Thanks, Mark. So, I was nervous there. Thanks for getting that done quickly. I apologize for taking up most of your time. But yeah, definitely the R&D credit is, Mark makes it simple, but there's a lot of work that goes into it. And we definitely go to clients together. And he did mention wages and hirings. And as you can see, there's research and development, which a lot of states like and does promote certain credits, and then there's hiring. We have hiring credits. So there is a big go hand in hand that you have to think of. So the benefits of credits and incentives, you know, it doesn't do justice, but at the end of the day, companies could really take advantage of these programs that are there. It's meant to incentivize their investment, their business, their hirings. They're going to do it anyways. They might as well make it better. Or there's a big project and they can help finance the project. There's ways with that, and states are willing to work with you, and so is the federal government. So definitely beneficial for companies that are you know, out there creating or doing research to help promote their own product, right? Discover something new, and doing the R&D or hiring, etc. They generate cash flow, and then, you know, how to apply. It could be done through, well, it really depends on the credit and incentive. Some of them are by statute, as we said. Some of them have an application process, have to be done on the front end. A lot of the hiring credits, you need to screen employees, make sure they're the right, and you make sure you get approval, and then you can take the credits. And then the benefit of the R&D credit, as Mark said, also, you know, very beneficial for companies, and then, you know, they can reduce payroll taxes too, in some instances. So that's, you know, that's very important. You know, just throwing this slide out there, just some recent success stories we had, both on the R&D side and, you know, state and local incentive side. As you can see, certain type of industries we've discussed, and the incentives could be pretty lucrative. And you could see some big ones, especially in the software development side, where you have a multiple R&D and state tax credits and incentives. In those cases, you'll see pharmaceutical and software, pharmaceutical and life science, and you have R&D in New York. There's a refundable credit as well. Besides for the QETC, which is the emerging technologies, a separate refundable R&D credit. Software development has that too, and the Excelsior program. Manufacturing has the ITC program, and you know, financial services also. There's the Excelsior and some other programs. So again, that's not all these are New York, but there's I'm putting them in perspective from what we did see in the pharmaceutical one and the software one. There were some New York credits there. But overall, you could see these credits and incentives could be pretty lucrative to business. So it's really important at the end of the day, when you're a business or if you're a service provider, to have those conversations and at least understand, you know, that these are very beneficial, and you'd be missing out on providing the best service to your clients. And therefore, you want to pay attention to what they're doing and have those discussions and reach out to you know, people that are involved in credits and incentives, and make sure we bring those opportunities to your client base. Thank you, Mark and Jonathan, for everything. And I'll turn it back over to you, Jonathan.
Great. Thank you so much to Barry and Mark. For anyone who has any specific questions, new business opportunities, or any other issues they'd like to discuss, please feel free to reach out directly to speakers or myself where appropriate, and I'll be sure to leave their contact information in the follow-up email to this program. As I mentioned at the onset, the goal of these programs is to stay up to date on timely wealth management related topics and to collaborate where appropriate. I think we can all agree that the clients who are best prepared are the ones who are served by a team of knowledgeable advisors. Two more quick items before I let you go. First, my next program will be on October 13th and is entitled How to Plan for Unequal Inheritances and the Complicated and Divisive Issues that Arise with Unequal Inheritances, featuring Avi Kestenbaum, partner at Long Island-based law firm Meltzer Lippy. Second, please take 30 seconds to fill out my survey at the end of this program. It helps me improve my webinars and provide timely and interesting content to attendees. I thank you in advance for taking the time to do that. And with that, this concludes today's session. Please stay safe and healthy. Have a wonderful day, everybody.